Hi, everybody, and welcome back to FANG Friday. This is Ross Healy, Chairman of Strategic Analysis Corporation and Portfolio Manager at McNichol and Associates Asset Management. We are going to look at the 6 FANG stocks that we follow. Plus, we'll also review Microsoft, which I've been reviewing for some while, and I think we'll take a quick look at CVS to see where it is right now. So, let's start off with Amazon. What I want to do this week is to review the metrics of the company just to show you where things are at the present time. Now, we have liked Amazon pretty much all the way through the piece until lately when the stock actually broke support here and has been holding down there for some period of time. And I think that the reason is reasonably obvious. The first thing, of course, is that the earnings forecasts have been shading a bit, and with it, the fair market value has been declining. Not a great deal, but it's been declining a little bit. But let's take a look at some of the other metrics. For instance, the forward price earnings ratio, very high. The price to book ratio, very high. And if anything goes wrong, the downside risk in this company is quite substantial at minus 71%. This may be a highly innovative company doing some enormously interesting things. However, we cannot overlook the fact that if in market weakness, there is substantial risk in this company. It's also interesting to note that the high of Amazon has been a little over 2,000, and the stock now is 1843, and this despite the fact that the stock market is trading almost at a new high. Turning to Facebook, same kind of a story. We have held Facebook more or less all the way through since we have bought it. But look at the action recently of that stock. It is clinging to its mid-super growth price. That's 5.5 times book value. It's been just clinging to that as it struggles to get its own cryptocurrency, for instance, approved. The European Union does not like it. And we don't know yet what the American regulators are going to come down with in the final in the final words. Reasonable price earnings ratio of only 22, and as I say, reasonable price to book relative to the rest of the FANGs of 5.5, and only a 20% downside risk. However, if this stock fails to hold on, it could drop at least to $152. Here's Netflix. Well, what can we say about Netflix? We have not liked the stock all the way through, and it just continues to drift. I think that's the operative word, drift lower and lower, heading down to its HB3. That is about 16 times its book value. The problem with Netflix, however, is, again, the price to book ratio close to 17, the price earnings ratio 58 times, and the downside risk in this stock minus 70%. And in the past, we have seen this stock has done that and indeed more. So the HB3 had better hold, or there could be substantial risk ahead for shareholders. Alphabet, well, when we started our exercise about 4 months ago, Alphabet was pretty much right at not quite at its all-time or 10-year high at any rate, but pretty much there, and we had thought that the stock would sell off, and sell off it did. Unfortunately, it didn't get all the way down to our target and has been rallying ever since. But over the period that we have been in, this what we call its putative FANG portfolio, the stock has actually gone nowhere overall. Turning to Apple, an interesting stock. The sales and the earnings have been really poor in the last 2 quarters, and yet the stock is hanging in there very nicely. It's hanging just about at its fair market value. And as I have shown you in the past, over the past 10 years, the fair market value has pretty much marked the peak of the stock. So while nothing much bad has happened in the past few months with Apple, nonetheless, we are concerned that the stock is extremely highly valued. NVIDIA, well, we started off and we got a nice sell on the stock and down it went. Again, we did not get a nice clear buy on the company, and it has rebounded since that time. We've had actually a kind of a head fake here. We thought we had a breakout. It failed. We've got another. Is this a breakout or is this a head fake? We don't know. The price to book ratio is sitting right on 10. Forward price earnings ratio 28 times, and the downside potential minus 42%. And of course, when you look at the long-term trend of the company, what you can see is what looks like a huge rolling over of the stock, just hanging here above its bubble price. Historically, when that's let go, we've had tremendous downside risk. Microsoft has never been able to get, or at least in recent years anyway, has not been able to get its HB1 price. That is just about 9.5 times its price to book ratio. Has a fair amount of downside risk here. But what I did last weekend, which I would just like to review again, is show you the relationship of the profitability, that's the fair market value line, against the price. And what we saw is in the past, and this is, by the way, it's a 35-year chart, in the past when the fair market value was high, so did the company get up to its HB1, and even actually a little bit above that. In the Windows 7 refresh, same thing. This time with the Windows 10 refresh, the profitability isn't nearly as high as it has been before, and I think that's why the stock is struggling at the HB1, and I would not be surprised if that turns out to be the absolute high. Now, the one stock that we brought to your attention as a buy was CBS, and at the time I showed you what the parameters were. It was, when we recommended it, it was trading just about its book value, PE of only 9 times, decent yield on the stock, and indeed the stock has done very, very well. It is now traded up about 20%. We are, however, somewhat inclined to take our profits now that we have got them. And the reason is that all of these lawsuits against the manufacturers of the opioids may well expand to the dispensers of the opioids. When we look, for instance, at Mallinckrodt, which is one of the public manufacturers of the opioids, of course, Purdue has recently declared bankruptcy. Here we have Mallinckrodt trading down at 6% of its book value, and the stock has just collapsed. Here, undoubtedly, we are probably going to see another bankruptcy here. But the issue that we have is this going to spread? And put it another way, here's a company with lovely deep pockets. Why not sue them and see what happens? Anyway, TBA. I think this may be a little bit overly cautious on our part, and we will see if the stock can break out. But right now, as far as we are concerned, we are going to take our nice 20% gain and see if we can live to fight another day. Anyway, this has been Ross Healy, Chairman of Strategic Analysis Corporation. I hope I'll see you next week, but I want to remind you that nothing, including investing, is difficult if you have the right tools. I'll see you next week.